Hello, hello, hello. Welcome to the Common Sense Show. My name is Micah, as you know, and I am the host. And we have a really good program podcast show for you tonight. I am so excited about this show. Just as a reference, I am an almost 20-year entrepreneur and startup company executive that has experience with talking about small business, talking about business, personal finance, building wealth, things like that. And I'm excited to be here today. I have a special guest that I'm going to bring on in a second, but I just want to set the tone for our discussion. If you are watching on YouTube, I'd like you to do some of the YouTube things. I'd like you to like, I'd like you to subscribe. I'd like you to share the video. If you're listening to this on your podcast, wherever you listen to your podcast, make sure you subscribe, make sure you share the podcast. You can rate us and review us. That's great. But the thing that helps us the most is liking. Excuse me. You can't like this. You can't like the podcast, but you can subscribe to it and you can share it. Those are the most important things. And so I wanted to just kind of set the table with that. But tonight, if you saw some of the thumbnails that I had out there, we're going to talk about the new mortgage program with Bank of America that they've been kind of introducing and kind of getting out there in the ether and marketing. And to do that, I'm going to bring in my guest. My guest, his name is Lee. And he is, I've known Lee for a long time. He is the production manager at Nations Lending, and he is here to drop some knowledge bombs. Just in our conversation about this program offline, he was dropping bombs that he's like, have you heard of this? Have you heard of that? I'm like, no. He's like, well, there you go. Lee, welcome to the program.
Thanks for having me, Mike. I appreciate it, brother.
Yeah, no worries. So first and foremost, before we kind of start getting into it, why don't you tell everybody a little bit about yourself, what you do, and all the good stuff.
Sure. Wonderful. Well, I run production for an office for Nations Lending. I've been doing mortgage lending for about 21 years. I've been in the real estate industry for about 30 years. I love what I do. I have a team with me that we're able to help a lot of different people who were at one time thinking they would not be able to purchase a home, all of a sudden through different programs being able to do so. It's an honor. The company I represent is great when it comes to giving opportunities to those who both qualify and those who need help to qualify. We also incubate well. So yeah, I enjoy what I do and had a good time doing it.
Incubate wealth. I like the way that sounds. That sounds like something I could actually I can get into. Yes, so this whole, I don't want to call it emergency podcast, but this whole podcast I'm putting together is on the heels of a brand new news story. And the news story specifically is about Bank of America's program that if they haven't rolled it out yet, they're going to attempt to roll it out. And like a lot of these programs that are good ideas on paper or in boardrooms, by the time they get executed are often challenged in court because people think that they're grossly unfair. And they end up getting killed on the table, or they don't have the intended effect that they used to. So I want to talk about the real nuts and bolts tonight of the Bank of America program. But why don't we set the stage by just describing it? And what I'm going to do is I'm going to share my screen, and then we're going to kind of go back and forth. But so what I have here is the new program from Bank of America, which they're trying to introduce a new program that's intended to expand home ownership in predominantly Black and Latino neighborhoods. Sounds like a great idea, right? We know that there's a wealth gap in the country between racial groups, and specifically, a lot of that wealth comes from home ownership. Is one of the areas that wealth gap comes from, but more specifically, one of Bank of America's ideas to try to help close that gap from where they sit is trying to introduce programs like this to boost Black and Latino, or minority, we should say, home ownership in areas that need it. They're specifically launching in areas of the country in specific markets to test it out. Charlotte, Dallas, Detroit, Los Angeles, and Miami. Los Angeles is almost prohibitive for no matter what race you are these days.
Yeah, it's going to be hard to buy a house.
But, like areas like Detroit could certainly use a lot more homeowners because Detroit in many areas is blighted. But at the same time, it has made, I've seen news stories, and maybe you have too, that it's kind of made some bit of a rebound in some neighborhoods.
Oh yeah, definitely.
Um, yeah, for sure. So yeah, so we're going to talk a little bit about this program, and so let's just start with the program itself. Lee, do you want to give a quick breakdown on the program, kind of how it's being introduced right now, and
Of
what
course.
we should know about it?
Well, what's really admirable, Bank of America is addressing or trying to address an issue that is complex. Home ownership amongst the races is an interesting dynamic. 72% of white households own homes. That's compared to 62% of Asian households, 51% of Spanish households, and 43% of African American households. So there's a concern with that large disparity. There's a concern as to how can that be changed. Now, unfortunately, some of these situations are ones that can't be fixed with just one fell swoop. And so when you have a program that's introduced, it has the best of intentions, as this program and other programs do, but they're going to face different obstacles that aren't addressed up front. And by piloting it in a few markets, hopefully they'll be able to address those issues. But the question is, how strong an address will they be able to do? Some of the things in the program that is standing out is that they're touting the fact that there's going to be no credit score requirement, no down payment requirement, and oftentimes programs that help those who may have lower down payment requirements have mortgage insurance. Well, they're going to take away that component as well. So you have mortgage insurance going away, you have down payment going away, and possible closing costs, which is mitigating a lot of the out-of-pocket expense. Sounds amazing, but then it leaves room for other concerns, as in how are they going to be able to tender any potential losses? There has to be, the whole term underwriting, which is a person who approves a loan, means risk assessment. So the question that's going to be asked is, how are they going to mitigate some of the risk that could come when it comes to eliminating some of those factors that are traditionally used to approve a loan?
Awesome. So that's a really good point. If you just before we kind of start rolling real deep, if you're watching this on Facebook and you're commenting on the video, I can't see it in the program that we're using to stream this. But if you are watching on YouTube, you can drop a comment if you have a question for Lee, or if you want to say something, and we can address it. So, kind of getting back to it, on paper, like you said, it all sounds good, and oftentimes, you know, there's a big difference between what a person wants to do, or intends to do, and what actually happens, right? So there's arguments about, should there be a minimum wage, should there be not be minimum wage, but when there have been times in the past when people have tried to adjust for minimum wage, and it drives other people out of business. So what people intend to do versus what actually happens. So the intention of this program seems good.
It
Um,
does.
and the amount of money that they're giving away is like exceptional and almost too good to be true. But the banks are businesses, and at the end
Yeah,
of the day, they have to make money, or they can't lend money to someone else. So
exactly.
to me, that means that there's a rub here somewhere.
And there is. And it's funny because the money is earmarked for the communities. But the other concern you have to make sure of is, because of the different laws, and we can go into the terms of the laws, but the specificity of it is there's no discrimination allowed, even if it seems like it will be beneficial. But it's not going to say, well, these are for Black and Latino borrowers. They're saying that these are areas that are predominantly Black and Latino consumers and renters and home buyers. So they're trying to address that, but anyone could be able to qualify for the program. So that leaves the question as to how many of these people in the underserved communities are actually going to be able to tap into that money. That's going to remain to be seen, but it's another concern. And the thing to keep in mind is that there are programs out there besides this one that are available for people to take advantage of. But a lot of times they don't have access to the information. And so they don't realize that programs are out there available that they can take advantage of to really get somewhere when it comes to owning a home, because owning a home starts that wealth pattern going
Right.
forward to getting that wealth.
Yeah, no, that's a good point. And I think that, you have to really pay attention to words. And so if you're a lawyer, their jobs are words, but most people's jobs are not words. When a company launches a marketing program that to address something like this, and they say in there to help address the issues in home ownership for blacks, Latinos, or minorities. They don't say for them because they can't legally say this is for them. They say to help address the issues with this group. So fundamentally, on its face, that message in general says that, oh, just so you know, this is helping to promote this in this area, hopefully with these people, but they can't legally or even constitutionally leave out other groups of people, or they're going to find themselves in the same courtroom in the Supreme Court, just like Harvard, the Asian students from Harvard and their admissions lawsuit, because you can't just take out one whole group of people when you're putting these programs together.
No, you can't. You can't. And so that's why we say that it's admirable for any company to want to give an opportunity. But the truth of the matter is, a lot of times, like you said, the program has the best of intention, but may have unintended consequences that folks may not realize. So it's important, in my field, communication is everything. So when a person comes to us to look for a loan, we're going to look for every program possible that could fit their needs. And a lot of times, if a person has income constraints that is preventing them from qualifying in a traditional manner, there are some grant programs out there that exist already. Mass housing, a perfect example of a variety of different programs available through mass housing to be able to put a person into a home right here in Boston, right here in the whole state of Massachusetts, to be able to have an opportunity that they may not realize they've had because they haven't been able to save up the exact down payment that they were anticipating to have.
It's funny because I've always thought to myself that why don't banks make it a requirement to inform if they have this responsibility, this fiduciary obligation to the people who are depositing money in their bank, whether it's $500 or whether it's $1 million, why don't they send pamphlets and emails and text out to people who they have this fiduciary obligation to, of varying income levels, to drive home the point that they have these mixed programs that existed prior to this marketing play that they're putting out now?
Yeah, it's funny because information is available out there, but you do got to search for it, and that's been something that unfortunately the search doesn't always lead to the pot of gold at the end of the rainbow. But truth of the matter is, there are a lot of good loan officers out there who are able to help a person to see, okay, this is what's available to you. But they have to have that conversation. The person has to take that step, because a lot of times just Googling it, you may not have the most accurate information. So right now, with one particular program being marketed, it's being talked about. It's the hot button. But there are several programs out there that should equally get as much consideration, because it could actually help a person. And a person may or may not qualify for this program that's being offered. They just might not. But truth be told, they may qualify for one of the other programs. So let's see the whole gambit that's available to them.
Right, exactly. So let's address what the realities of this could be. And you kind of started mentioning it that other groups, other unintended groups that can come in and can crowd out the ability or the availability of these programs to be used based off of the fact that there is no specific target direction for this program when you actually peel back the marketing layers and you actually look at it.
The question, sorry.
Yep, go ahead.
I would say the question is going to be, if the qualifying factors that are normally used are not used. The way that it's being touted, for example, is that it is going to be rental income, rental history that's going to be taking the majority of the consideration. But the question is, if a person has been through other financial hurdles that they've had to get to this point, will that have an impact on their qualifying? That remains to be seen. As I said, they're doing a test market to see exactly what it's going to be. So this and many other questions is, okay, who's really going to qualify? And traditionally, time has shown that programs have come out where, like we said, people would want, oh, I hope I qualify, I expect to qualify, but there are other underlying factors that play a role in making sure that the person actually can get to that program. So by knowing that there are other programs out there, it will prevent discouragement. That's my biggest fear, is anyone would be going through a program, not get through it, and not get discouraged, when in actuality, there are other programs you could take advantage of.
What are some of the unspoken hurdles so everyone talks about the credit score, obviously, because we beat the drum of the credit score all the time. And, I think the whole credit score system needs a big update anyway. And a lot of people have said that in the finance industry, but what are some of the other mitigating factors that could prevent a person, even in this program, in your opinion, from not even being able to qualify for this program?
Well, possibly. And once again, we are limited in the knowledge that we have about this program, so I can't speak on the official capacity that it won't be for this program. I have to state that up front. But truth of the matter is, you look at any financial hurdle a person may have been through. Will bankruptcy play a issue, for example? If a person has been through either a Chapter 7 or a Chapter 13, will that play an issue? If a person has had a limited job history, will that play an issue as to whether or not they're going to qualify? If a person has actual assets, will that prevent them from qualifying because they have too many assets for the program? See, all of those different factors play a role in the majority of different programs. And so a loan officer always navigates through them. So though the information is being shared with us in an exciting fashion, it remains to be seen what other factors are going to play a role in determining where a person qualifies.
And so I think those are all good questions, because there's so much stuff that comes into play when it comes to looking at like job history and how much one makes and how much one earns. And not having to put 20% down is a big thing. But let's just take out let's take out a market and just examine the market. Let's talk about LA. The median home price in California in general is like $850,000.
Mm-hmm. Yeah.
Okay, you go to Compton, those houses are still selling for $600,000
easily.
So a person who is has a job that doesn't pay them, at $600,000, a person who has a job that doesn't pay them more than $45 an hour, how are they going to even be able to, even with no down payment? Like there's only $1 in the world that exists.
Yeah.
And it can only go so many places. How does that ratio factor in? Like, how do you even get to that point?
And unfortunately, that's a big problem, Micah, that is faced in the industry in general. People are being pushed out of qualifying. Excuse me about that. I thought this was off. People are being qualified for or trying to qualify for a home that is becoming further and further out of reach. Some have chosen to use multiple incomes within the family. The FHA program, for example, allows for what they call a non-occupant co-borrower to be able to come in and help to add income to the overall household income. But even in general, that payment itself, how high is that payment going to be?
Exactly.
You may qualify, all of a sudden that payment is going to be so far out of reach. And the fear is that, like we had happen years ago, that if a person's in a home that they cannot afford, for their own peace of mind, they just walk away. And that's something that we don't want to see, because those mass walkaways that happened years ago had an impact on the economy that really overall pushed things back several years, if not a decade.
Yeah, it's ripple effect, right? It is. It really is. It's like, okay, so $3,200 a month for a mortgage, let's call it, right?
Mm-hmm.
$3,200 is $3,200. Whether the house is worth $600,000, whether the house is worth $800,000 in LA, whether the house is worth $300,000, you're not paying. So if a house is worth $300,000 and the mortgage is $300,000, it doesn't matter that you're not paying the 20% down. You still $30-something $100 a month could be a person's whole check, or at least 50% or 60% of the. And I'm assuming in the mortgage industry, I think what is the ideal mortgage to income ratio is it shouldn't go over 30% or 33%.
32% is what we usually go by. So for your example, $3,200 mortgage, we're looking about an $8,500 monthly income before taxes.
That's $100,000
right away. Yeah. So now a person's put in that position, and will you end up becoming house rich and cash poor, where you won't be able to do some of the things you want to enjoy in life, even going out going out for dinner, going out to restaurants. All of those little things that we take for granted become now something you can't do because housing has become so expensive. So that's another concern too. And then the other part is right now we're at kind of like a higher point in the market when it comes to prices. The anticipation is that it's not going to go down the way it did in 2008, only because the economy is structured differently. But let's say it were. Let's say you buy a home at $600,000. In fact, we'll use Massachusetts. The average median home in Massachusetts is $549,000. Mm-hmm. So let's say you buy the home at $549,000, where the average median is, and it drops to $525,000. Well, at this point now, you've lost $25,000 in equity. How long will it take for that to gain back? And as you pay your mortgage down, yes, you're going to come up to that point, but will you ever be able to build equity position? Well, that's where wealth begins. A lot of people who bought homes 5 years ago, made out really well in this economy because they were able to sell the home at a premium and be able to extract that equity and be able to use it for all other types of things, maybe investing in another home, maybe investing in all other types of things, and wealth begins to grow. But now, if you're in a negative equity position, where does that wealth start from? It becomes a concern.
That's right. And you either have to be able to generate it through your job or through assets that you own that produce income, or something to that effect. But the reality is that that money has to come from somewhere, right?
Somewhere.
Like you have to be able to generate it, and if in order to make $8,500 a month, call it on a $3,200 a month roughly mortgage, that's a lot of scrap to make $2,000 a week. You have to be working, hustling pretty hard. Now, if you have a couple of people in the household with two $50,000 jobs, that would work out. But still, that's a big task because there's not a lot left over, especially if you're like a family of four, have a couple kids, have 3 kids, and that goes down really, really quickly because it's not even the mortgage ratio of 32% to whatever your life expenses are is tricky because it doesn't even compute real life, right? It's not like you have kids, they get sick, they go to school. What happens if they go to the bad school? What about gas? What about that bill that kid has at the hospital that you have to address? There are a lot of things that these programs don't address, and I think that's, to go to your point that you talked about what you all do when it comes to insulating wealth, I think that's really, really important to talk about how money actually works.
I think that's so important, Michael, because a lot of
Yeah.
times, in our communities, we're hard workers. You know what I
Mhm.
mean? We're making sure we make our bills paid, but we don't think from a fiscal like ahead, saying, okay, in 5 years, my house will be worth this, my mortgage will be this, and there's my return on my investment, my equity right there. A
Mhm.
lot of times, we're just trying our best to survive. And so the education part plays a major role in making those predictions and making that preparation for the future, because wealth is so key to being able to provide stability as you get older.
Right.
Health becomes a concern,
Mhm.
and even to leave something as a legacy to your children. All of this is where, with the beauty of home ownership. But the problem is, if it becomes out of reach, then now a whole community may not be able to take advantage of this way of growing your financial base.
Right. That's exactly right. And, I think that when it comes to generating wealth and um, trying to generate income and things like that, like finding ways or ideas to generate the cash before you park it in an investment like real estate. And I get it. There for so many years there was this whole thing behind, it's the American dream to own a home, right? And then park your wealth there, and real estate and all that stuff is good. But then you read a book like Rich Dad Poor Dad by Robert Kiyosaki, and you could also read Dave Ramsey, and then of course they butt heads about the position of debt and everything. And here I am talking to someone in mortgages about debt and Dave Ramsey, but the reality is that I firmly believe that debt plays an important part to wealth building, as Robert Kiyosaki talks about, and so
I agree.
but there's a key aspect of the book that people don't talk about when they talk about Robert Kiyosaki, and everyone talks about debt and the real estate piece. He also said in that book that you need to build income producing assets that produce enough income to pay the debt down so that you don't have to work to pay it. And so, in my opinion, I don't think that people should even get into real estate until they've built up income producing assets, maybe through a business or company that they don't have to work, 40 hours at, or whatever the case is, and then get in there so that they don't have, so that, okay, the mortgage is covered based off of all the income that I'm making doing these things, that's generating income for me, and then that will pay my mortgage, and then I can focus on building wealth or building income sources, after I get in or whatever the case is. But I think that there's some value in considering, especially in 2022, where the internet exists and this whole internet economy exists, where there's so many things. Like I can imagine the amount of people that you've spoken to in the last, call it, I don't know, 3 or 4 years, who have like 4 side hustles. So they're doing like 4 things for income right now. It's because those things are necessary to produce income to pay for life. And you only have so much time to be able to dedicate to produce an income that actually matters and that could go to building wealth. Where if you get screwed out of a program like this, frankly, then you know, you're stuck, and then the house still goes back to the bank, who's going to resell it to someone
That's
who
always
actually
a
has good
fear.
credit.
That's always a fear. One of the things that I think that was, especially in Massachusetts, especially in Boston, we look at is purchasing. If a person is looking to purchase a home, considering buying a multifamily home, a duplex, tri or quad, because those that, to your point about income producing, you could be able to purchase this home. And for instance, use the FHA program as an example. FHA is a Federal Housing Administration program. It's a great tool for helping a person to purchase a home that may be a multifamily, using the other units to be able to basically alleviate the mortgage payment that you have. And now all of a sudden, now you have an income producing property, and you're able to now let it basically churn for itself and take care of the entire picture, as you now leave that as one of your building blocks to having multiple different ways, streams of income. I'm a strong, firm believer in multiple streams of income. But if you're just stuck with one, and now you're stuck with an asset that isn't giving you a return, you may run into a situation. Another one of my favorite programs that I do a lot of is renovation programs. So we purchase a home that needs a lot of work, or may need some work, but the person who is selling it may not be in a capacity to do so. So you're able to get it at a reduced price, put X amount of dollars into it. All of a sudden now the value of that home is higher. So now you have equity in the home, but you also took out a loan that was lower. So right now you have that equity position. And if you combine that with a multifamily property, now you're taking both directions and being able to grow yourself wealth. So I believe that if you have a proper game plan, proper guidance, real estate is a key part to helping you to invest. But just throwing it into, a program, any program, not this one per se only, but any program that doesn't give you opportunity to grow wealth, then it's something you should think about considering. What am I doing? What is my end game? What is my result 3, 5, 7 years from now?
Yeah, is that the 203K loan, the construction loan that you're talking about?
There are actually 3 different ones that we offer at Nations, and there are several ones out there. There's 203K, which is the FHA version, Federal Housing Administration version. Fannie Mae has one called the Home Style, which is a great program. And then there are also some private investors that do fix and flip programs. We're doing quite a few of those right now, where investors who already have their homes are leveraging some of the equity in their homes. I've had some of my investors take out home equity lines of credit to be able to, within reason, be able to extract it for a down payment on another home, be able to flip that home and be able to use it. And by flipping, we mean purchase it, renovate it, and sell it, right? And they're able to flip it in a way that they're actually now able to extract wealth. And of course, talking to your tax person, talking to the right people, using a 1031 exchange is another way of being able to mitigate your tax liability. Now you have this whole game plan where you're seeing your wealth start to grow, and it's all because you've leveraged what you have properly. And that's what we want to encourage, leveraging. See, those of us who may not fully understand the power of home ownership need to talk with someone and get an actual plan together. It's exciting to own a home because everyone else does it. But now it's the question is, what does it really do to my overall game plan for the future? And I think that that's a great tool to use to be able to really have a real plan for what you want to go going forward.
There's some utility in your first home if you're trying to build wealth and even increase your income, to your first home being that multifamily versus being a single family. I do think that there's a lot of power in that being your first home, because honestly,
versus being a single family.
here I am
There's a lot of power
playing this video by accident.
first,
But
because
I was wondering who's the other guest.
yeah, exactly. Sounds like he's talking to himself. But there's so much utility in having that first home be like a multifamily, and then if you want to go to a single family after that, because then you can generate income for the entire building, and then and then go from there. Anybody just do that. So like I think that you're right with game plans. It's so funny in business. I always, if I'm coaching someone and we're trying to talk about kind of what business they want to be in, and generating money and cash and all the other stuff that goes along with starting a business and game planning and everything that's going to come along with it. It's first question is not what kind of business. The first question is, what do you want your life to be like when you exit the business?
You couldn't say it better myself. Perfect.
Because honestly, that is going to inform every other step in between when you start and when you sell it. And if you can sell it. And so that's the other piece. Like, okay, can you sell your business, or are you going to just close the door? Most businesses close not by being sold, but by being the door is just closing and the owner haven't made whatever money he's going to make. So so there's nothing wrong with you just closing the doors and making the money and then closing it. That's fine. However, you're still going to have a gas bill and a cell phone and car insurance and medical insurance. And typically, unless you're Benjamin Button, your health doesn't get better.
No.
As you get older, it gets worse. So then there's long-term care bills, of course, that pop up too. So there's a lot of utility in putting that life plan in place. And here's the thing. It doesn't matter how old you are. And I think that people get caught up in, oh, am I too old? I'm too old to have a plan. No, it doesn't matter how old you are to have a plan. I can't imagine.
Sorry, Micah. Mm-hmm.
Yeah, no, I can't imagine how many people come into you with no plan but want to buy a house.
Yep.
It's like, how do you go from 0 to 400,000?
and that's honestly where the whole conversation starts. My first question when a person walks into my office is, tell me your story. Tell me your story, because I want to understand how this home is going to fit into your life. And if you've been in a situation where you just started a new job 2 months ago, and you're trying to get everything together, you're excited. I'm excited for you, but I don't want you to be in a situation that's gonna fall apart 6, 8, 12 months from now. But at the same time, you mentioned about age. One of my favorite stories is Colonel Sanders from Kentucky Fried Chicken, how he worked hard to build up a business for years and didn't get Kentucky Fried Chicken off the ground until he was in his 70s. And look how much of a mainstay it is part of American culture today. So age is relative. The big thing is the plan. What is your vision, and can you put it to paper? And a lot of times when you start putting something to paper, now you start to converse with people like yourself, a business coach, like with other people who are in the field. And you don't become myopic. Look around to all other business owners. What made you able to market yourself properly? How are you able to make sure you leverage costs? Because that's one of the biggest things too. Most businesses fail because they fail to turn a profit. They may have a great idea, but if they're unable to turn a profit, now it's going to be an issue. And then all of a sudden your expenses that you've put into it, the profit doesn't exceed the expenses, and now you're forced to shut down. So by having that plan, having that 3 to 5, 7-year vision, you'd be amazed at how much it happens. But you also just got to push yourself to do it. In the past, and COVID has proven that so many people have the ability to be entrepreneurs and truly have an entrepreneurial spirit. It takes a lot of work. You are not going to become an entrepreneur and go golfing 6 out of 7 days a week. You just can't. You have to build your business. But as you're doing so, you're going to see it's going to take a life of its own. It's going to open up opportunities for you that you never thought possible. And that's why I love entrepreneurship, because it gives you that opportunity, but you got to let it grow into that direction.
So let's talk about the programs that we kind of mentioned before as alternatives to this Bank of America program. And you had mentioned that, and I think that this is probably the most profound point. People talk about it often across the board, which is everyone has this great idea of what program should exist for people in lower income or to make people's lives better. It's 2022. The government, since the war on poverty that Lyndon B. Johnson signed, has spent $22 trillion on poverty. They've thought about most programs out there that people are like, it's a good idea. But one thing that you said earlier was people just don't know about it. There are so many programs out there. So let's talk about that gap in that gap in knowledge, and let's kind of spill some knowledge right now. What programs are out there that actually work for people with lower income, lower credit scores, that don't have the ability to put down 20%, even 10%? Like what's working right now?
Oh my goodness, there are some great programs out there. Well, I mentioned the words FHA, and you'll find my industry has a lot of acronyms, but I mentioned the word FHA to begin with because that is designed as the most lenient on a person when it comes to credit profiles out there. The FHA program keeps the rate at a reasonable place, keeps it competitive with conventional programs, but allows a person to put 3.5% down, which is great. A lot of times, most states like Massachusetts or Virginia, where I actually cover the entire East Coast, most states actually have what they call bond programs. And these bond programs are designed to help a person to be able to get either a grant or what they call a piggyback loan to be able to cover the down payment. So the 100% financing is available through that. Mass Housing has some great programs. They're even introducing a great renovation aspect to their program. So that's a great tool right there. As you become more rural, you have a program called, another acronym, USDA. It's also 100% financing, and it's great because it allows a person to be able to buy a home that's outside of usual city limits. It's more rural areas, but they're able to take advantage of it and get 100% down with very low mortgage insurance. For those who are veterans out there, the VA program is such an outstanding program that so many do not take advantage of. It has no mortgage insurance. It's 100% financing. And there are so many aspects of it that allows a veteran to be able to take advantage of being able to build wealth pretty quickly. And their appraisal process is a little bit on the stricter side for the purpose of making sure that a veteran will not be going into a home that needs more work than they realize would have to be able to handle. Also, there are some other programs out there. One of the programs we offer at Nations Lending is called the Chinoa Fund. It's a program several lenders do offer. We specialize in it here. It also offers 100% financing. For those who may not qualify for the programs I mentioned a moment ago, they can qualify for the Chinoa program that gives 100% financing, an FHA-based program. So right away, conversing with your loan officer to see what programs work for you are great. Another thing I like about Fannie Mae and Freddie Mac is they both have what's called the Home Ready and the Home Possible. Though it's not 100% financing, it's 3% down, and it's able to go with conventional financing, which means the mortgage insurance is lower, and it's great for the community. Now, a lot of times folks don't realize that if you have a 401k at your job, likely you can extract money from that 401k with little to no tax liability and be able to use that towards your down payment, which is awesome. And if you combine it with a grant program you may qualify for, now you're really looking at not having a lot out of your own pocket that you'd have to save up for in order to get there. I mean, you see how excited I get about talking about it, but there's so many things out there that aren't marketed out loud. And something that shiny new object comes along, and that's great. But there are so many other programs that have been conversed about that everyone can benefit from.
So, Lee, that's great. And I'm speaking like a person who's listening to this, but I am 45 years old. I have one credit card. My credit score is 615, and I have $1,000 in my bank account. 500 some days, depending on what time of the month. Doesn't the bank look for a certain amount of money in your bank account? Aren't they looking at the fact that blah blah blah? How do you respond to that?
Every program is different. Some programs are looking at your credit score, minimum credit score requirements. So the first thing that I would do as a lender, and a lender would do, there's a lot of great lenders out there. They'll look at your credit profile and say, okay, making these small changes and over the next 30, 60, 90 days can make that much of impact. It can be that quick. You can see your score go up 10 or 15 points. Not by the magic you see in commercials, like just do the boost here and there, but actual changes to your spending habits that might be able to change that. As well as a lot of the grant programs take into consideration limited cash out of pocket for that specific reason. So they'll look and say, okay, you may only have $1,500, $2,000 in the bank. So these programs are designed to help mitigate that worry there. So that's where the conversation becomes really important to make sure. It may not be just like that, but it may be by sitting down, like we've talked about having a plan for business, but having a plan. I have a lot of clients that we sit down, we map out what's going to happen over the next 3, 6, 9, 12 months. Even people who have had a bankruptcy, if you've been out of bankruptcy for 2 years, you can qualify for a home. And remember, the law states that a first-time home buyer is considered to be someone who has not owned a primary residence in the last 3 years. So let's say you've owned a home before, and for whatever reason, you no longer own it, and 3 years have passed since then, you have now become refreshed as a first-time home buyer and can take advantage of these programs. It's not one and done. So that conversation, Micah, is so key. Let's talk. Let's map out a plan, and then we'll stick with the accountability play. A lot of times with my clients, we're talking on a monthly, 45-day basis. How are things going, Micah? How are things going with your plan? And that way you feel good. You feel someone's in it with you, because that's the other part, Micah. I've learned in 2 decades of doing this. Most of the time, folks just want to be heard. And a lot of times they're not. They're just a number to some lenders, and then they get discouraged and never make the attempt again. Talk with a good loan officer. Stick with it. Stick with your plan. You'd be amazed at how fast you'll actually own your home.
You think it's because there's just appears to be so much to it?
I do. I think it can be overwhelming if it's not explained properly. That's one of the things that me and my team try our best to do. And I don't want to, we talked about, I don't want to shamelessly plug my team, but one of the things that we do is to make sure we make it as simple to understand as possible. The process takes into consideration seriously 3 areas: credit, income, and assets. So as we hit one area, we hit the second area, we hit the third area, all of a sudden now you see yourself in front of a home. but it's not rocket science. It's actual math. It's just conversation and actual planning.
Do you think that, so on a psychological level,
Mm-hmm.
these programs are not asking for people who to get into these homes with basically anything? You just kind of basically getting in, and it's a big grant. It's a home on a grant.
Yeah.
Does that have what kind of psychological effect might that have, for instance, on someone who doesn't quite have skin in the game? I'm not saying that they have to have 20% down or anything like that, but do you know any statistics or anything where programs, where people have less skin in the game, how it affects them and the long-term success of home ownership, and like not putting anything in? Do you think that might actually affect them on some level? The fact that they didn't, there wasn't much pain to get in there. Like, what's your thoughts on that?
I think that there's a potential for that to be a real problem, but here's a caveat to that. When we look at a person's rental history, we see that they've been able to make their monthly rental payment on time for X amount of dollars, $2,000 per month, for example. Let's say they're able to make that regularly. If we keep within a 10% range of that $2,000, the person is less likely to fall off the wagon. If we put a person in a 50% greater, we go from 2,000 to 3,000, that's going to be hard, because you may think, and even on paper, it may seem like you're going to be able to afford this, but truth be told, you have to live your life. You know, a person could sit down and say, well, I'm just going to get rid of cable. I'm going to get rid of eating out. I'm going to get rid of all that stuff. But that's what makes you you. You have your shows you like on Netflix. You have all the things that make your life worth living, so to speak. Not to be melodramatic, but, you know, it's important to say, okay, I don't want to go outside of my range. And a lot of these first-time homebuyer programs take that into consideration. Mass Housing has a great budget workshop that they put together for a person to be able to make sure that they're not staying outside of their range. And so it may feel restrictive. A person may qualify for a lower priced home than what their eyes may desire, but it's worth it to make sure that the home ownership aspect, you own this home. Or even when we talked about a duplex, a person may say, well, I don't want to buy a duplex. I understand, but look at the long term. You have your home. You're going to pay rent anyway. Might as well pay a mortgage and then let it work for you. So by working with a loan officer, by going to the education classes, and by doing that, they're going to be in a better position. That's one of the things that Bank of America's program does talk about. But these programs, like I said, Mass Housing, and other ones like that, already have home ownership counseling involved in it in order to make sure that a person doesn't go outside their means.
So I'm going to put you on the spot, and you can answer or not answer, of course, but let's talk about the programs that you don't like that get, that some people think are good programs, and I know that you may have to walk the two rails instead of hit the third rail, but you can tell me what you can tell me.
Well, I'm speaking in general. I don't like programs that put a person in a position that they weren't ready to be in. Like we just mentioned a moment ago, there are, for example, adjustable rate programs that you have to be cautious with. Adjustable rate programs are not for nobody, but they're not for everybody. They have to be just right, because your rate may change in a certain amount of time, and you weren't prepared for that, or your lifestyle hasn't changed enough to do that. I'm also cautious of programs that are not. We use a term in mortgages called QM, which is a qualified mortgage. So when a home is in a non-QM program, you have to be careful, because the terms and conditions may put you in a position where you'll be priced out of your mortgage within a short amount of time. A lot of the programs that existed back in 2008 are gone, whereas negative amortization, things of that nature that were really hurting home ownership. But there are programs still out there that could cause you, you get in the door, but can you stay in the house? And that's going to be a concern. So that's where I'm very cautious with.
Yeah, and that's smart. And I think that comes into, again, having a plan for what you're going to do. Look, if you don't think that your job is going to change, your employment, if you don't think that you're going to change very much, if you like doing kind of some of the same things all the time, why even get in an adjustable to save? And I get it. Some people get in it. You're right. There are people who like adjustable rate mortgages because there is benefit, but these people are typically higher net worth people who are dealing with a lot more expensive homes, and there's going to be that cash that comes in where they can refinance, or they're going to cash out or whatever, and they can split before that rate adjusts. But people who are just regular folk with standard lives, put yourself in a position like that, and 2008 all over again. Where rates are adjusting and people are trying to battle to just stay, like you said, stay in their home. Forget lifestyle. Lifestyle's like out the window at that point. These people were just trying to like eat and live and whatever the case is. But so what's the future of this? I want you to put your prognostication hat on. What's the future of this program from BOA? Is it DOA? Is it DOA for BOA? Or do you think it's going to last?
I think overall it has the potential to last, but the question is going to be when they face the issues that are going to come from it, how do they address them? Because obviously other lenders are sitting by watching and see how this program is going to work. And this has the potential to open the door for other lenders to say, yeah, we're going to do this, we're going to do that. But until that happens, the question is, how are they going to handle some of the questions that are going to come out? I think it's smart of them to stick with only 4 markets to begin with, but I don't know if those 4 markets are the best ecosystem of how the underprivileged areas are going to react. You have places like New Jersey, New York, even here in Boston, where you may have situations that are different than those other 4 markets. So I think it has potential, but it's a wait and see right now. And I hope that's not too ambiguous an answer, but I would hope that if it does work, we're going to see a lot more homeowners around, and that makes me excited, because I think home ownership is should be attained, especially the statistics I gave you in the beginning of how much of a disparity it is. I would like to see more homeowners out there being able to take advantage of being wealth building.
Yeah, I find it interesting that they have Los Angeles and Miami, two very high income, very well. Miami, it depends on the neighborhood, but of course, but Los Angeles, two markets where home prices, Miami, the home prices have soared, I think 14% or something in the last year. Los Angeles, I mean, those prices have been high forever, but the average, we talk about the median price being about $850. And then they have Detroit, right, which is an interesting dynamic. It's probably the only kind of the lowest income of the Charlotte, Dallas, Detroit, Los Angeles, Miami, but it will be interesting to see how it plays out in a market like Los Angeles, where people, I mean, you have people who are middle class, firmly middle class, maybe kind of bordering middle class, upper middle, who can't get homes in Los Angeles. Like, my question is, I wonder if this is going to breed resentment to other people, if people are going to try to work against it. And then ultimately, is there going to be, it seems like a large haul for a financial institution, especially given the prices of some of those homes in some of these markets. Like, how are they going to be able to, unless they cap the mortgage, which how in the world are you going to do that unless it's a short sale or foreclosure? Even in a market like LA, you either have to cap the purchase price of a house so that the bank doesn't completely go bump, unless the federal, well, I could also see the federal government giving them like $100 million to try this experiment out too. So there's probably that too, but we'll see how it goes.
I think they're probably looking at the markets too and seeing exactly what the median, how the median is going to rise. Already, because of the Fed's funds rates changing throughout the course of this year, you started to see things start to taper off. Even prices have started to taper off, not in dramatic numbers, but numbers enough to raise an eyebrow. I think last month median home prices rose only or went down by, or median prices were at 3% lower. So it's not a dramatic enough drop, but it's enough to say, okay, is this working? Because the whole idea of the federal funds rate changing is to basically stave off inflation. And inflation is hitting all the commodities as well as, real estate. So I think lenders would take the time to look and see all that as they're looking at risk. But that's one of the things that remains to be seen. A lot of the stuff that they're sharing is tight-lipped. They're not sharing a whole bunch of their information, which is understandable, but we'll remain to see what the impact is of the program.
And if you've watched any press conference with the Fed chair, Jerome Powell, then you see that the Fed rate has only been raised about a half of where they want it to go, which means that when the federal rate rises, then banks are going to start lending mortgages at a higher interest rate. In general, it's just going to happen. So it will be very interesting to see how high those rates get, because the cost of cash is going up over the next. I think the cost of cash is going up a lot over the next 3 years. I can't give you a percentage right now. I can't think of one, but it's going to be It's going to cost a lot more to do business, and I don't think it's going away anytime soon.
And I think that's a very legitimate concern. The federal funds rate, though it does not directly correlate to mortgages, it impacts the economy. And as
Right.
the economy starts to do what it does, it does impact mortgage rates in general. So you're right, the cost of banks borrowing from each other is going to happen. Jerome does say that he's going to keep doing it for, the better part of 2022 and 2023. So that remains to be seen also.
Yes, that's right. And that is a fundamental wealth building. And maybe we could talk about this on the next call, but that's a fundamental wealth building thought, which is how much is my money going to cost me? Because money costs money. And, if you can understand, finances on that deep level to see how much money is costing you, then you will make some seriously different decisions about how you borrow it, how you spend it, and where you get it from, I think, ultimately.
I agree.
Lee, where can people get a hold of you if they have questions?
Please check me out right on my website. Really simple. My first name, Lee. Lee did my loan. Like, who did you loan? Lee did my loan.com. Or feel free to reach out to me on my telephone number, 804-514-8254. I'd love to talk with you.
Awesome. That's cool. So, anyways, we wanted to get this podcast out to you, this special podcast about the new BOA mortgage program that they're piloting right now. We'll be monitoring this. I'm going to have Lee back so we can do a recap on this once we get some data and once we review the data and see kind of how it actually has gone, and to see if other lending institutions are actually going to be kind of following suit with BOA, or is it going to quietly? I feel like a lot of these programs, they start off big and then they get petered out without even telling anyone. They kind of just go the wayside. So thank you for coming on today. And remember, folks,
I appreciate it.
Yeah. Anytime. And we're going to follow up. You're the mortgage guy now that we're going to have on. You're the mortgage expert. So if you don't go to work building your dream, you're going to go to work building someone else's. So until next time, I'll talk to you later.